thank you all. I did this last year. I wasn't quite sure how I should present, because I know some people have done privates, as you taught here. Others I don't know much about the markets, so I thought I'd start kind of basically and work from there. So let's go from that. So first thing I thought of, why does this market even exist? You've heard of it. Why does it exist? And you have to go back all the way back to the sort of the Great Depression era, after the shenanigans of the 1920s and the market crash. So the rule is that if you want to issue a security in the United States, you have to register with the SEC and file and disclose so that everybody's protected, particularly widows and orphans. That's basically the idea. But like everything else, there's always exceptions. So there's an exception that says that, you have to file with us. However, if you investor can fend for yourself, you're sophisticated, an institutional investor, that's fine. But the rule is that you have to buy these securities and hold them. So you can't buy them and trade them immediately. So that's the idea. That's sort of the trade-off. So the question is, who in the world would want to buy a security that you can't trade? Doesn't that sound like a kind of not a very fun thing to do? What are you going to do with it? So that's sort of the idea. So the answer to that question is, who buys it? Life insurance companies, U.S. and Canadian life insurance companies mainly. And the reason why is because if you think about a life insurance company, they have an actuarially determined liability structure, outgo of money. So, you're a 35-year-old male, non-smoker, living in Omaha, Nebraska with 2.1 kids. You have another 51 years to live, sort of thing. But they have long duration, and they know the outgo over time, what that's going to be in terms of liabilities. So they're very happy to match assets against that liability structure, and they can be illiquid assets. They're happy with that. There's matching liabilities and assets. That's basically how it works. So in terms of who actually does this now, you can see they have the logos here of a lot of the insurance companies. So there's about 60 to 75 of them. Some people think there's more. But actually, of this group even, there's sort of like a hardcore group that really provides the financing. Very familiar names to almost all Americans because these insurance companies are selling insurance product on the retail level. So I always think there's nothing more persistent than an American life insurance salesman. But so you'd know, if you're in America, you know these names. So, like Allstate is the Good Hands people. Nationwide is On Your Side. MetLife has Snoopy, has their logo, and they're the friendly company. Prudential is the Gibraltar, the Rock of Gibraltar, very solid. So very, very familiar names to us. And this is the key. Without these guys, then we don't exist. These are the key to the market. All life insurance companies are managing money for life insurance portfolios. Not entirely. That's sort of the essence of it. Also, the bid size. Some of these investors, like MetLife, Prudential, they can bid $200 million, $250 million per transaction. There's also much smaller insurance companies that are providing maybe $1 or $2 million. All part of the market, all part of the family, if you will. So now we've established that they can buy U.S. private placements. Why do they do it? What is the value proposition for the insurance companies? Well, first of all, I mentioned that they are long duration oriented. So they love the idea that they can make long-term loans. It's perfect for them. So 7 to 30 years, there's even 40-year money available. Shorter maturities as well, but that's it's really a long duration market. They also believe that they're able to obtain an illiquidity premium because these are not public securities. They can't trade them. Therefore, they believe they should get paid for that. That's a value proposition. And I mentioned that they think so because that illiquidity premium can be bid out of the market like it is right now, we think. They also have the ability to actually interact directly with senior management of a company, do thorough due diligence. They're able to obtain diversification through sectors, issues, geography. That's very important to them because in the public bond market, it's the same issuers coming all the time. They get overweighted in those names. They love diversification. Very important for the health of their portfolios. They're also able to obtain financial covenants that are similar to bank covenants typically. That's their protection. They can't sell out that security, but they do have a covenant protection. Very important for them. They also have prepayment protection in case the issuer decides that they want to prepay the bonds, they can do so. But the yield that the insurance company thought is going to obtain at the outset will be maintained through a make-whole calculation. And the historic performance of this asset class has just been excellent for them. So there's a whole lot of demand for this asset class right now. That's why they want to buy that. Now, from your position, why do you find this market potentially attractive? First of all, again, it's sort of the mirror image, right? So if you're looking for long maturities, if you're a utility, an infrastructure company, manufacturer, or otherwise, you might wish to have some diversification in your borrowing arrangements so that you have a longer average life. This market is perfect for that. I mentioned up to 15 years because that's about as long as the swap market will go, but there is longer maturities available in the market. You can also have customized maturities and amortization. So you can have bullet maturities or amortized deals that are frequently seen in lease-type transactions. You can size the transaction according to your wish. I say $75 to $1 billion. There's been 2 over $1 billion deals done so far this year. You can also do tiny deals as well that may not be cost-effective. Covenants are typically no more restrictive than bank covenants. So the market is not demanding anything more than you're already given to your other financiers. Documentation is fairly transparent. There's a model form that's in the public domain. You can see exactly what kind of contract you're going to sign up for. You can obtain confidentiality. That's a hallmark of the market. You can develop close relationships with these investors over time. The market is very stable in terms of personnel. A lot of these investors have been doing this business as long as I have, which is 20 plus years. You get diversification of funding sources. That can be a very important thing right after the GFC. We hear it a little bit less now, but still important. No rating is required in this market because the people that we sell to are credit analysts, very skilled. If a transaction is rated, that's fine, but they do their own analysis. Then the last thing is pricing. Is the pricing going to be attractive relative to your alternatives, of which there are many, and many attractive alternatives these days? So just think about pricing for a second. I'm just going to give you, this is like a hypothetical example of how pricing works so this is a U.S. dollar fixed rate market. So how do we get from fixed to BBSW? And the way you do that is, this is sort of an example, I'll go through it pretty quickly, but basically you're looking at the 10 years as a benchmark maturity. 10 years, you look at the Treasury yield, and that's in this case 2.65%. You add the spread that's been agreed to. So the bid, in this case, I put 100 basis points just to make it easy. So you get a coupon of 3.65%. That's payable semi-annual. It's fixed rate, U.S. dollars. So you need to convert them to floating to get down to BBSW. So we basically just go to the market and you convert fixed to floating to LIBOR, right? That's semi-360 LIBOR. Gross that down to get quarterly. And so we have a quarterly of 88 basis points over LIBOR. So that'd be your equivalent, right? So either do the fixed rate 100 over or LIBOR plus 88. We then need to convert the fact that we're dealing with 2 interest rates regimes with interest rates much higher in Australia than the U.S. That's the conversion factor. It's a multiplier. Then add the basis swap, U.S. dollar BBSW basis swap. It's 29 basis points right now. And that gets you to the spot BBSW. So it's 126. We normally settle in 1 month. That brings it down to 122, and there's also a 3-month delayed available, so another 2 months. And the importance of that is that our market will say that we'll price you today, but we don't need the funds drawn down for 3 months from now, and there's value in that option. I won't go into the details of that, but it's worth about 7 basis points depending on maturity, so it's quite a valuable option. But the point of this slide really is not that. It's really to point out that there are variables in the pricing, so things can change. LIBOR can change versus treasuries. The conversion factor can change, basis swap, et cetera. So these are like a dynamic pricing model that all the treasurers are looking at all the time, comparing that with the other pricing options that you have available to you. Okay, so question for you. This is a great market. Just how big is it? So here's the choices. 1.2 trillion, 1.02 trillion, 58 billion, 27 billion, 110 billion. Any guesses? Go for which one? A? 1 trillion? No, sorry. I wish it were. It's 58 billion, just 58 billion. So a trillion would be more like the U.S. public bond market. So 58 billion, so kind of a disappointment there. Gee, I thought it was bigger than I was just, what a great market it is. And actually, it's a record year at $58 billion. But actually, it is significant. It's really, these insurance companies are huge. But as I mentioned, this asset class, they maintain about 10, 15% of their fixed income portfolio in private placements. It's very important for a balancing factor. So they love it. But compared to the domestic bond market, corporate, which we estimate to be about $10 billion last year, so about maybe 6 times larger than the corporate bond market here. So $58 billion, that's overall, that's global. Here's another question for you. What percentage of the USPP market is from Australasia? Here are your choices. 2, 7, 10, approximately 10, I think an analyst is giving a little hint there. With 33%. Who says 10? 10% is the correct answer. Yes, about 10%. So actually, so that's about $5 billion last year, obviously. But you can see here over time it's been very consistent. One year we're at the 16.9%. It's been about 10% for Australasia. Okay, about $5 billion or so a year. So I'd say very consistent in a very important part of the market. Let me show you another slide here that's interesting. This is actually, we took this from Private Placement Monitor yesterday. So this is from 3 different jurisdictions, Australasia, that's actually 2, but UK and Canada. And with Australasia being yellow, and this is going from oldest to most recent, 2013, you can see that, early in 2004, 2005, there's more issuance being done out of Australasia than was out of the UK. Now that has changed recently. There's been a ton out of the UK, but it's a very important jurisdiction for the non-U.S. issuance, which is quite important. So the $5 billion or so that we see a year is important, I think, for you, say 20-some transactions a year. Also very important for our investor base. That's the point of all that. Now, I put some pie charts here because I think no presentation is complete without a few pie charts. So pie charts here are just showing where the issuance comes from. Australia we just talked about, Australasia it should be, Europe, UK. So all basically English common law based jurisdictions. Europe would include, some that are not, right, Germany and so forth, but very established countries of issuance where our investors feel very secure in terms of their contracts. And then also, just to show the diversification, lots of different industries are financed, a lot of different sectors are financed there. The ones that have turned to be the most favored out of Australia would be infrastructure. There's been a lot of airports been done, ports been done, rail, utilities, and property has come on very strong recently in the last year. And then just make the point here about the duration, so you can see that for under 7 years, just 8% of the total volume. So it's really a long duration kind of market, which I talked about before. Kind of beat that horse to death, I think. Okay, so what is the outlook for the USPP market? And this is just, I just want to show you some smiling faces. There are some agents nestled in there, but if you look at the top row, so there are investors there representing some of the top insurance companies, and they're seasoned, they're smiling, they want to lend you money, they're out there, they want you to come to Miami and meet them, so they're real people, and they're easy to work with. They got a point of view, but they're easy to work with. And here's the feedback we got from, we had this conference in Miami, you could get this from anywhere, but from just talking with investors. So what do they expect? What are their concerns? Well, from that we'd say there's huge demand for this asset class right now. And that's a worry for our investors because they're saying we're getting absolutely killed in allocations. We're bidding $100 million, we're getting $10 million kind of thing. But that's just because there's just more demand than there is supply. The market is $58 billion. How large could it be before it satiates demand? Nobody really knows. It's never been tested, but it's going to be at least $100 billion, one would think, just based on the allocations. We see another development is the middle-sized investors who feel like they're getting squeezed out a little bit. They're increasing their bite size. They're increasing their allocations to this asset class so they can be more meaningful. So if they bid $40 million last year, they might bid $90 million this year. Generally, our investors feel very comfortable about the global economic environment, and they feel very comfortable with Australia. A number have come over here to do sort of fact-finding tours. We have one right now that's doing that. And generally, they're saying we are very happy with our experience in Australia. It's proven to be a very good jurisdiction for us. We want to continue lending here. That's true of New Zealand as well. So all very positive, I think, from getting money for this part, from investors in this part of the world. Now, we had to ask the question to the investors. We said, okay, now, who is your favorite USPP agent? And we were absolutely shocked when this came out. Whoever brings us the next deal is our favorite agent at that time. Just to say that, everybody's looking for deals, right? That's what the name of the game. So outlook for 2014, we are seeing right now pretty strong compression in spreads. So I mentioned that illiquidity premium, which most people say, well, that's anywhere from 0 to 50 basis points. That's probably getting closer to 0 right now based on recent transactions. So that's been sort of squeezed out of the market. Investors will try to add value by providing delayed funding, so that's added value to the issuer. Non-U.S. currencies, Aussie dollars are available, Canadian euro, told a transaction in Hong Kong and Singapore dollars last year. That was a hallmark transaction. Also, there's floating rate available, LIBOR-based funding available. Also, BBSW floating rate. We did a transaction on BBSW terms last year. So investors are trying to find ways to make their money more attractive. There's also a lot of more direct lending. So investors calling companies that they've issued to before or not and saying, would you like our money, without going through an agent. We abhor that practice, but it does go on. And in search for diversification, we see more. I think there'll be more of a movement, as there always is in this part of the cycle, for lower quality credits, strictly minuses, where they get more yield. I call them BAA4s. That's sort of, you're not quite sure whether it's investment grade, non-investment grade is sort of around the cusp. It's really get some yields, maybe some more covenant protection. Smaller companies, middle market companies instead of the larger ones. And also, but mega deals, I think we'll see more mega deals. I mentioned there's two so far this year. And I say push on structure, meaning that, in this part of the cycle, people are competing on price and then eventually start competing on structures. So we'll see looser structures. We've already seen that for a couple of transactions we did last year. So that's the state. So from your standpoint as an issuer, I would feel pretty good.